as well, though. Podcasting will
some sort of resilient performance as well. So let me quickly cut to the chase on that one. Our net revenue came in at 77,000 crores, up 5%. Most of it coming from forex gains, basically because of pound sterling rupee exchange rates. In the Indian domestic environment, I think TML domestic business delivered a robust, profitable growth this quarter. And as far as the JLR numbers are concerned, weak sales in China and the destocking impacted our performance there. The destocking is something that we had called out in the last quarters, and you also heard it during the course of this quarter as well as decisions that we have been taking on that. Our PAT was at negative 26,961 crores, impacted by an exceptional item of asset impairment in JLR of 27,800 crores, almost 3.1 billion pounds. The EBITDA at 6,522 crores was 8.5%, and EBIT was broadly break-even, impacted by the weak sales in China and destocking in JLR. So that's what happened. With respect to Tata Motors standalone business, the turnaround 2.2 delivered under challenging conditions. Our revenue was up 1.5%. Our market shares are up. Our profitability is up, and our profits are up. So it's been quite a resilient performance despite weak growth environments here. Our EBITDA stood at 9.1%, and our EBIT at 4.3% is now up 70 bips this quarter as well. We launched Tata Harrier, as you would know, during this in the month of January, and particularly excited to see Tata Nexon achieving its 5-star global NCAP rating for safety this quarter as well. CV EBITDA is now stable at 11.6% despite significant market challenges that we saw, and PV business sustained its EBITDA break-even this quarter as well. So therefore, it's fair to say that turnaround 2.0 is now well on its way to deliver even in challenging times, and we continue to focus on winning decisively in CV, winning sustainably in PV, and winning proactively in EV. And we will continue to focus on embedding the turnaround culture further in this organization as we go forward. When I then move on to Jaguar Land Rover, the performance was impacted by corrective actions that we have taken in China, the weak market conditions there, and the production shutdown there. The revenue at 6.2 billion was down 1.4%, and PAT at minus 3.1 billion pounds basically got impacted by the corrective actions that we did on taking an impairment on our assets there. In terms of actions during the quarter, we launched the all-new Range Rover Evoque with hybrid options. This is a brand this is a nameplate that actually brought JLR back in the reckoning, so we're very excited with this particular launch. And one thing which we did call out last quarter was Project Charge. Happy to confirm that Project Charge is well on track to achieve its 2.5 billion pounds target. The cash benefits have started to flow in, and this quarter we picked up a cash benefit of 500 million pounds. We are now confirming that the 4 billion capex plan that we had laid out, we will be well below 4 billion this year and next year as well. So that is actually the 1 billion coming out of that will happen. And working capital also is very much under control and continuing to improve further. The work that we are starting the work on is on the P&L side of it. 1 billion of P&L is what we had planned to take out of that, and that work has started. You would have noticed the announcement for redundancy of 4,500 people in a scheme has been announced, and that is something that we will see the benefits of in the coming quarters as well. We have taken a one-time exceptional charge for asset impairment. This reduces the growth and depreciation and amortization rates by almost 300 million per annum going forward. So it's a right step that we have taken in terms of reducing our costs, improving our break-evens, and as well as ensuring our competitiveness. So along with this and the charge and accelerate, we are now taking clear and decisive actions in JLR to step up its competitiveness, reduce costs and improve cash flows and make the business fit for future. So that's in a broad summary what has happened, and let me now turn it back to you in terms of questions, if any, that you may have.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Priyanka Iyer from BTVI. Please go ahead.
My first question, Mr. Balaji, to you is that, talking about the asset impairment that you have spoken about, what if you could give us the details in terms of the assets are? And also going forward, as you said, this will help you in the future in terms of decreasing your costs. So how will we see the next quarter going forward?
Just to clarify, the way the impairment model works is that there's a slight bit of technical accounting here. Bear with me. JLR operates on one cash generating unit. That is, the overall company's one cash generating unit. And what we have done is taken a look at the current assets that are there in the books. No future investments, no future plans that we have. Just taken a look at our current assets that exist in our books, and thereafter checked it for, stress tested it for the low growth environment that we are seeing today, particularly coming out of China, and rising interest rate environment and the kind of technology disruption that is happening, and therefore assessed it to say that what should be the carrying value of those assets. So therefore, that is what has got reassessed to this revised number. And the implication of that is that going forward, because these are fundamentally assets falling in either, a lot of them sits in product development costs that have been capitalized before, and sit as intangible assets in our books, as well as some property, plant and equipment as well that is also there in the book. Now impairing to the extent that we believe the cash will be. We are able to confirm that this is the revised number for this asset in terms of given the current situation that we are having, and hence we have taken a charge in the books. Now that we have taken a charge in the books, this will reduce our future depreciation outflow by almost 300 million at the minimum every year, and that is what we have called it out as well. In terms of the overall plan for our profitability, this year we are expecting to see it be marginally break even, and going forward into next year and beyond, we see a 3 to 6% EBIT plan and a 7 to 9% EBIT plan thereafter. And that is something that we are committed to, and this is something that will help us achieve it because it is reducing our break-evens big time.
That how will things shape up in China? We also saw a rate cut a few days ago. Is that coming in as a positive in terms of the demand sentiment that you're seeing there, or will it take a while for the issues to resolve, especially with China and the US?
First, let me take US as the easy one for us, because US we have been growing well ahead of the market, and Land Rover is the fastest growing brand in the US today, and therefore we are beating the market quite by a mile as far as US and UK are concerned. In fact, in this year, US, UK, and Europe, all the three markets, we are ahead of the industry growth, in premium industry growth. The market that has really been a problem for us has been China. But what we have done there is a series of actions during this quarter. One is we have aligned with the dealers and got a complete agreement on what is going to be our approach going forward. We have changed our strategy from a push to a pull strategy, where we are not going to focus on sales. We are going to focus on profitability of the dealers and ensure retail and not wholesale. So for the focus shifts forward, and thereafter focusing on building the brand further, so that we are able to generate customer pull and take off from there. So that is a complete change of approach for us in China, which we called out in our last quarter, and we have implemented during the course of this quarter, and I'm happy to confirm that we have got buy-in from the Chinese dealers as far as we implement this year. So we see a gradual improvement in China going forward. We are happy to see our numbers stabilize now in terms of growth rates, in terms of offtake. And now we need to get back to nurse it back to health, improve profitability of dealers, and grow back from there. So that is the plan in the coming months.
So just one last question in terms of the operational efficiencies that you had spoken about, and also a change in organization structure that you spoke about last quarter. Will we see any people, any employees being laid off? Will that be the step going forward? Because there were also reports about that. Or there will be other operational efficiencies, and how much will that be? Will you be looking at further efficiencies than what you had told us last quarter?
No, we are sticking to that at this point in time, and those actions are currently underway. First 3 months, you've seen actions on capex and working capital. Then in early January, we announced a redundancy program of 4,500 people. So therefore, the overhead stuff and all others will start from now onwards. So that's our focus of phase 2 of charge. I think we need to move on to someone else. Others will also be equally keen to have questions. So thanks for asking.
Thank you, Mr. Balaji.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants, you are requested to restrict your question to one per participant. Time permitting, you may return to the queue for your follow-up questions. Next question is from the line of Sonia Shenoy from CNBC TV 18. Please go ahead.
Sir, thank you so much for taking my question. The question I have is on margins. This time around, JLR margins have fallen 360 basis points year on year to 7.3%. What is the outlook like for the rest of the fiscal? And last quarter when we spoke, you did indicate that, the JLR margin picture may at best be just about break-even at the PBT level versus the 4 to 7% EBIT margins that you expected earlier on. Would you want to change that guidance in any way?
Three comments from my side. When we called out, we haven't given a guidance. We have talked about, you shared what are our plans that we are working with. Therefore, from that perspective, EBIT break-even is what we called out at that point. We are now likely to be marginally negative because China is a big factor. We're almost there. I don't want to still give up. We will try and hit the EBIT break-even, but right now it is marginal EBIT break-even is what we have called out. Marginally negative is what we have called out. With respect to what is causing the movements with respect to year-on-year numbers, mix is a big one for us because with China is one of our most profitable markets. That is coming down, is costing us almost close to about 250, 260, 290 bips in our entire profit drop, the drop in China, the drop in mix for that because of China. The other is 260 bips is coming out of one-time costs that we incur because when you take out production, you end up having a significant incurrence of labor and overheads as the production comes to a standstill. You still end up paying it, and therefore that is the second impact that you have. Along with that, there was one-off in the base, which the investor deck slides has all of them in the website. It is available. You can take a look at it. But these are the two large reasons. One-time cost of about 260 bips and about another 260 bips coming out of China and the mix-related matters because of China.
Say that earlier you expected an EBIT break-even, but now you're expecting marginally negative EBIT. What would the timeline be? By when do you expect this negative EBIT?
My marginally negative is for the full year FY19. We expect to be a marginally negative, which means next quarter is a significant step up in EBIT that we have lined up. And that is more well and truly secured.
Thank you very much. Next question is from the line of Samir Hashmi from BBC News. Please go ahead.
Hello, Mr. Balaji. Thanks a lot for taking the question. I wanted to ask you about, the UK with Brexit, all the uncertainty around it. Already, Tata Motors, JLR rather, had announced that they would be temporarily shutting down their plant in April in light of what's happening in Brexit, what's happening with Brexit. So, what is the plan on that front as far as the shutdown goes, and how worried are you about Brexit, and has that changed your plans for the UK market specifically, because you have a lot of plans over there?
Yeah, I think from a short-term perspective, in terms of, we still believe it's in everybody's interest to get into a negotiated settlement with the EU, and we want free borders and frictionless trade. That is something we've been consistent about, and we continue to expect that as our base case. Having said that, given that, we also need to prepare for a scenario where there could be disruptions. So we have called out, we are preparing for ourselves by first accelerating or moving forward some of the Easter breaks, the way we schedule production, so that we are able to keep our factories running as much as possible. Given the complexity of an OEM that you would well appreciate, it is almost impossible for us to stock up all our raw materials and keep production going. It is just not physically possible. And therefore, we are going to have from the end of first week of April, we have about 2.5 to 3 weeks of production shutdown that will happen, and therefore that is more preparing for the worst case scenario. But we still believe that there will be a negotiated settlement sooner rather than later, and therefore as far as the UK market per se is concerned, our plans remain unchanged. And as far as the manufacturing footprint in UK is concerned, there is absolutely no change to our plans at this point in time.
2.5 to 3 weeks?
Yes. And
okay.
This again, the update of this is available on our website on the investor deck, which I will take the analysts through later today. So there is here one slide on Brexit that you can take a look at. We've talked about both short-term and long-term implications on that.
And just to confirm, there are no plans of any more job cuts, which were already announced last year. After that, there are no plans of more job cuts.
At this point in time, what you have announced is what it states.
Okay. Thank you so much.
Thank you. Next question is from the line of Manish Shekhawat from Press Trust of India. Please go ahead.
Hello.
You may proceed, Mr. Shekhawat. Your line is unmuted.
Yeah. Mr. Balaji, when was the last time we had a greater loss of more than 26,960 crore for Tata Motors?
I think the point is a one-time impairment charge that is being taken, so it's not fair to compare this to the past. Situation is different and market conditions are different. So we are seeing the pain that the auto OEM worldwide are going through, and therefore it's not fair to compare this with anything else in the past or maybe in the future.
Okay. Fair enough.
Thank you. Next question is from the line of G. Balachandra from Hindu Business Line. Please go ahead.
Hello, Mr. Balaji. Good afternoon.
Good afternoon.
Sir, a couple of questions. I think your CV margin of about 11.6% or whatever, close to that. What has actually helped in this, despite challenging market conditions? You come with this EBITDA margins. What have been the key factors in this? Second question. Given the challenges in terms of liquidity constraints and axle load norms related issues, do we see a stagnant sales in the fourth quarter also? Because we expect the pre-buying to happen only in the next fiscal. What are your views?
Yeah. I think with respect to the margin improvement of CV, I think Puri has been consistent. Combination of realization, mix, improvement in costs, specifications, better cost management, engineering out design changes. It's what we have been sharing for the last many quarters now, and that roadmap continues. And therefore, we are quite happy with the progress that we have made. And in particular, I'm happy that despite challenging times for the M&HCV market, which I'm sure you are well aware is one of the most profitable segments that we have turned in a resilient performance on that one. As far as that's on the profitability, with respect to our outlook for this quarter, we are again refer to the investor deck that we have already uploaded on the website. You can take a look at that. We do expect the near term to be challenging due to multiple reasons. Liquidity is gradually coming back into the market. At the same time, the axle load has resulted in a capacity overhang in the market, which may take a few months for it to work its way out. And therefore, there is clearly related matters on consumer confidence, how the fleets are going to buy, etc. So there is some bit of concerns on the near term. But the medium to long-term story of this industry remains intact with the kind of infrastructure investment that are currently happening, as well as the overall GDP boom. Because for all practical purposes, we as a commercial vehicles industry, we transport GDP. And therefore, to the extent there is bullishness on the GDP, there is bullishness on the CV market as well. And all metrics that you take in terms of penetration rates of SUVs or need for higher vehicles, because don't forget that with the axle load restrictions now being the design changes are there. We are the first OEM in the market to actually put out trucks which are now redesigned. Now you're getting a huge fleet of trucks that have been redesigned for the new axle load norms, which is going to help the customers to manage their TCOs even better. So I think we are very well ready for the uptick in volumes as they come through. But it is fair to say in the near term, we need to work through the challenges that I have explained before.
Okay. Did you have price increases in the third quarter in the CV business?
We did.
Okay, fine. Thank you. Thank you so much.
Thank you very much. Next question is from the line of Karunya Rao from Times Network. Please go ahead.
Hi, sir. Thank you so much for taking my question. Just want to understand to what extent will the leash on costs, how is it panning out for you so far, putting a leash on the costs? By when can we actually see it reflect on your numbers? Because last time around you had said that Q4 onwards you're expecting the business to turn around for JLR specifically. Are you on track for that?
Let me split this into two. There is Tata Motors domestic, CVPV, and there is JLR.
Right.
As far as the turnaround plans, the cost out plans of Tata Motors is concerned, you're already seeing in the numbers. So though we have done a revenue growth of 1.5%, we're still improving our profitability by 70 basis. We still managed to, despite the low growth environment, we managed to keep our EBITDA stable in both CV and PV, and we managed to continue to deliver the EBITDA break even there. And also I can confirm to you that starting this quarter, we are starting to report retail growth of both CV and PV as well, formally. So the domestic retail sales for us is well ahead of wholesales. So we are managing our dealers' pipeline inventory also extremely carefully to ensure they are also becoming profitable as we move forward. So from a turnaround perspective, for me, I'm quite happy with the performance that's happening in the domestic business.
What I essentially wanted to ask you was for the JLR business, because you had really highlighted extensively about your cash management plans and strategies. Just want to understand what is the timeline by when we can see it actually reflect on the performance, and also if you could talk to us if the long-term guidance of 7.9% for JLR remains intact, or is there any revision to that?
Yeah. So I finished this, so you have to let me finish my response. So as far as JLR is concerned, as I said, even in my call, it's there in the deck as well, we are now well on course to deliver the 2.5 billion of cash out plan. We started by removing the more urgent matters, which is cash, and therefore CapEx and working capital we focused first. We started moving on to the P&L side, so that's the reason the 4,500 people announcement went out. And therefore, we are now starting to move as far as the P&L is concerned as well. So the current year, when you are looking at an EBITDA break and a marginally negative EBIT, there will be a significant contribution coming in from the charge project as well. Most of it will start moving from Q4 onwards into the year. The full 2.5 billion delivery that we had committed is an 18-month delivery ending March 20. And we are absolutely committed, and in fact, we should be well on course to delivering that number.
Okay. All right. Thank you so much, sir, for taking the question.
Thank you.
Thank you. Next question is from the line of Ketan Thakkar from Economic Times. Please go ahead.
Hi, Mr. Balaji. Just curious on the demand environment in China right now. It appears that your rivals are taking a different approach to react to the slowdown, whereas JLR has taken a extremely aggressive approach when it comes to safeguarding your inventory.
simply because we look at the right number, because finally what matters is what the consumer wants and not what we sell into the trade. So that's what would be our request. And we have now moved ahead and made that move, and we'll stick to that move. And that's in line with the enhanced transparency we want to put in the market as well. And the sentiment-wise, in terms of how we expect to see it moving forward, I think maybe it will take a little bit of time for it to play out, and we are watching it extremely carefully. But at the same time, we are not held back on innovation. So Harrier has just got launched, and you'll see the activity level of Tata Motors in the market will continue to remain as though business as usual.
If you allow me, just one last question. How about the preparation for BS6? Because we are getting into a disruptive next financial year, and there will have to be a lot of inventory management, probably starting this quarter or next. How prepared are you? Because you are dealing with probably more than hundreds of models to be transitioned to BS6, and how are you preparing for that?
Great question. A highly operational point, and something that we all have to be absolutely on top of. And so far the preparations have been good, getting ready for BS6 from a technology perspective. We are well on course, but now is a question of understanding from the market how people are likely to react, what level of pre-buy will happen, what's the level of retail offtake will happen. So we are now deep in conversations with all stakeholders to ensure that the cutover is as smooth as possible. And it's going to be one of the most intense projects for all OEMs, including us, during the course of this year.
Is it because of that?
Thank you. Mr. Thakur, may we please request you to return to the queue for your follow-up question, as there are several participants waiting in the queue for their turn.
All right, thanks.
Thank you. Next question is on the line of PR Sanjay from Bloomberg News. Please go ahead.
Hello?
Hello.
Mr. Sanjay, may we request you to please speak a bit louder, as your voice is very feeble.
Is it audible?
Can you come a bit closer to the instrument?
Hello?
Yes, please go ahead, sir.
Hi.
Hello. Yeah, go ahead.
Sir, when you were saying that you have taken corrective action in China, but still the scenario looks very bleak, and when do you expect a kind of a recovery for China market, which is very important market for you?
We are expecting to see it play over the next few months. That's what we've called out. And the reason we want to be cautious there is the opportunity is so large. It is important that we get it right. So therefore, we are taking methodical steps, and at the same time, and it is done in a very planned manner. For example, we have moved away from wholesale incentives to retail incentives. We have simplified our entire incentive structures. We have ensured that the retailers are first brought on board in terms of our plans, and they have bought on to it. We have ensured that we are now starting to train the dealers in the right place. We are ensuring that most of the time it works on local registrations, so that we are incentivizing only local registrations. So there is a fair amount of high quality work that is underway, and therefore we are quite happy with ensuring we do it right rather than rush into it. And I'm confident that this is the thing what will pay us rich dividends in the long run. This is exactly what we have done in Tata Motors PV as well. We have just put our head down, got our basics right, then it starts firing. That's what you will see us doing in JLR as well.
Okay, thank you. Let me get back.
Thank you. Next question is from the line of Yatan Mota from Bloomberg Quint. Please go ahead.
Hi, so thanks for taking my question. I have a couple of them. First, talking about the earnings and the losses that are there in this quarter, do you think this will impact your credit rating by any chance? Because, last week there were a couple of rating agencies which have kept the JLR ratings on watch. Do you think this write-off would probably lead to a cut in ratings, or are you confident of retaining your current credit rating?
I think we should understand let me try and explain what is...
It's a non-cash write-off, I understand that, but still, I just wanted you to explain if there is any technicality which will lead to a rating cut.
Let me explain that, yeah? It's a non-cash charge, as you rightly call out. Number two, it's a 6 billion net worth after the impairment.
Okay.
And my gross debt, leave alone net debt, my gross debt to equity is 0.78 to 1.
Okay. Okay.
My financial covenants, most of them, there's almost no financial covenants on my net worth. So therefore, we are confident. And more importantly, I think it's also about understanding what is happening in this, because if it is about what is the real value of the assets that you're carrying, this actually confirms what is the real value of the asset that people should be looking at. From those assets that are currently in use, forgetting about future assets, future investments, future growth, all that. All those assets assessed at a most conservative level, because that's how impairment testing is supposed to be done. So we are quite confident that people will see it in the right light. As far as the rating agencies are concerned, their risk, both the risks that have been called out is related to Brexit, and the fact that nobody knows what the outcome of Brexit is going to be.
Correct.
And from our perspective, let's wait and see. And we are hopeful that there will be a negotiated settlement, and we are all for frictionless trade. That's what our main ask is of the Brexit piece.
Okay. Sir, one last question.
Maybe please request you to return to the queue for your follow-up, please.
Yeah.
Thank you. Next question is from the line of Sharun Tambala from Cogensis. Please go ahead.
Hi, this is Apuza from Cogensis. I would like to know if, this write-off means that all your future investments in JLR are based on hope of a recovery in the market rather than visibility of demand.
Sorry, I must admit I didn't get your question. Could you just repeat it, please?
Yeah. So this write-off that you've done in JLR, does it mean that all your future investments in JLR are going to be based on hope of a recovery in the market rather than visibility of demand?
Okay, maybe let me try and understand it slightly differently, or let me explain how we think about it, and I don't know whether it answers your question or not. As far as all our investments are concerned, we are absolutely clear that JLR, with its distinctive brands, cutting-edge technology, and the kind of features that you put into the cars, has got an exciting future ahead. And therefore, we'll continue to keep investing in products, we'll continue to keep investing in technologies, and we'll want to stay ahead of the curve. And if you look at the current sales plan itself, you'll notice the E-Paces, the I-Paces, the Range Rovers, the Range Rover Sports, all of them are firing all cylinders. All my markets are firing, barring China, which we talked about at length earlier. So frankly, for me, there is absolutely no reason for us to be diffident about investing as far as JLR is concerned. So that is step number one. That's how future investments happen. The impairment process works slightly differently, where you just take investment that you already have in your books and test it for stress in a situation of slowing down China, a rising interest rate environment, and the technology disruptions out there. And where we felt it is prudent that we write down that investment, because their future in the basis on past technologies or whatever may be there are not firing to the extent that we would have believed earlier possible. And that is just explaining how the market has changed over the last 2 years. And particularly China coming in over the last 6 months have been very, very intense. And we took 3 months to understand what is happening, and now we are clear that we need to reflect that in our numbers, and hence we have taken the impairment. The implication of that is that it gives you relief in your depreciation and amortization line going forward, and that gives you then strategic flexibility to step up your investments and direct investments to where you see the future is going to be, rather than be saddled with investments that you have made in the past but are not generating returns. Hope this helps clarify.
Does it mean that Tata Motors is done with all the charges related to JLR for now, except the one that you pointed out on retrenchments?
I think at this point in time, we have taken everything possible into consideration. That's what we have done. That's how accounting is always done.
Okay.
Yeah.
Thank you.
Thank you. Next question is from the line of Siddharth Bamre from ET Now. Please go ahead.
Hi, good evening, Mr. Bala, and congratulations for the numbers. But then Street might be disappointed with the impairment. But I want to, talk from futuristic perspective. And you mentioned two reasons for impairment. One is change in technology, the disruption which is causing, and second is slowdown. Going forward, are you looking more of EV market? And if that is the case, are you anticipating further spending?
I think we've called out EV as a portion of the total is likely to be at max 25 to 30% going forward. So the remaining 70% is still going to be IC engines with a fair mix of diesel and petrol as well. And we're already seeing that coming back in UK, for instance. US, we are seeing gasoline continuing to boom. So I don't think you can just write off IC engines as fast as we think it's possible. At the same time, the penetration of EV in the overall portfolio is likely to increase. And one of our blockbuster performers in this quarter has been iPace, which continues to do exceedingly well for us. So the disruption is well and truly on. And we need to ensure that we stay competitive in the midst of this disruption. And that is the reason why this impairment has been taken. As far as... sorry, you need to repeat your second question. Sorry.
Yeah, so my question was how much spending more in pipeline if you want to foray more aggressively into EV?
We have given a clear plan of how we intend to spend. So this year and next year, the number will be 4 billion, down from the 4.5 billion. That's a 1 billion, 9,000 crore savings that we have already clocked into our numbers. And going thereafter, it will be more like 11 to 13% of turnover is what we are likely to be. And that is sufficient for us to keep our products moving, sufficient for us to ensure that we keep investing in our technologies. And that's what we intend to work towards.
Thank you so much. All the best.
Thank you.
Thank you. Next question is a follow-up from the line of PR Sanjay from Bloomberg News. Please go ahead.
You have already answered the question, so I will get back.
All right. Thank you. Next question is a follow-up from the line of Yatin Mehta from Bloomberg Quint. Please go ahead.
Hello? Hello?
Yeah, Yatin, go ahead, Yatin.
Yeah, sir, just, the follow-up question I wanted to ask you on, EBIT margins, given the fact that, there are challenges in Europe and there are challenges in the Chinese market, do you think you will be reasonably confident of achieving that 4 to 7% band in probably the next, 4-5 quarters, barring the next 1 or 2 quarters? Do you think that is visible given the fact that you're also looking at a cost-cutting drive, reducing your working capital and supporting your dealers? So how does the math really work in order to you getting that 4 and 7% EBIT margin range?
One is from an EBIT margin range, we have calibrated to a 3 to 6%, reflecting the challenges that you outlined in terms of China and others there. At the same time, our long-term margins intact because we believe it will be a temporary business will get back to normal. And at the same time, the work on charge and the work on the corrections we are making in China as well as other business interventions we'll anyway be making and the kind of exciting products that we are landing because we have Evoque lands now. We have the new XC coming in. Thereafter, we have the entire the Defender coming in. So we got a rich pipeline of products that are coming in. And therefore, the combination of these two makes us quite confident that this is a realistic plan and something that we can gun towards.
So for taking that question.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. Next question is from the line of Ashutosh Radhesham from Economic Times. Please go ahead.
Hi, sir. Just looking at one thing, that this impairment charge is, you are saying this is because of this technological thing or the low growth. So if we presume that this disruption goes on and this low growth environment continues, do you think that we might have to take some more impairment charges? And is this impairment charges related to some of those platform which were low volume and now you are going to write off?
I think the way the impairment works is that you don't just look at current, you forecast out current positions and the accounting will force you to take conservative views on growth, conservative view on margins going forward and expect it to almost continue forever and then say that what is likely to be a cash flow generation starting from that. So I think it is fair to say that we have taken our best shot at it in terms of what's likely to be the corrections we have to make once and for all, and that's what we have done. And therefore, we believe that's the best thing that we can do at this point in time to ensure that we retain strategic flexibility and are also able to invest where we want to invest going forward.
Second was I was looking at, you were looking at a Brexit, means your base case, what you were looking at is there will be a settlement in terms of negotiated settlement. But in case of a hard hard Brexit, what exactly you are looking at, or you had that shutdown will really work out in a way that will suffice to take care of that hard Brexit?
I think that's more a short-term this one thing, because in a scenario where ports do clog up, we need to ensure that we continue to produce in the most optimal manner, and therefore this shutdown just gives us breathing space there. Yeah, and we are hoping our base case remains that we are able to get a negotiated settlement going and borders continue to remain free. As far as the implication, the hypothetical scenario, in case there's no deal, we need to look at all possible matters, because it also depends on what the kind of movements currency will make, because currency is likely to depreciate is what we understand.
Yeah.
And therefore that does make us more competitive. So therefore we need to keep all the factors in mind, and therefore instead of speculating on it, we have simply said, let's see it as it comes. We are hoping that a negotiated settlement is the best way forward.
No, I'm just, as you said, in case of that hard Brexit, are you looking at, in case of the currency depreciation, some more hedges that you have taken, especially in that 2-3 months kind of a tenure when things can be a little dicey?
No, at this point in time, we are keeping it as business as usual, simply because we believe the system will come to a negotiated settlement. And our main plan of action is to ensure that the immediate disruption coming from ports clogging up is something that we need to plan for. Everything else, we'll have to plan for it once we know what the outcome of Brexit is. Otherwise, we are shooting in the dark, which may not be a right strategy given our financial situation at this point in time.
Okay. And last one, sir, you said then 3 to 6% now you're looking at EBIT guidance. Is the 3 to 6% you are looking for FY20? And then from there on, you are looking at 4 to 7% that you are looking at? Is there some bit of a change in the earlier guidance for the FY20?
First of all, I haven't given a guidance. I keep repeating it. It's a plan that we are working towards. And when we're calling out a 4 to 6%, that was between FY20 and 22. And that is something that we are now calibrated down to FY 3 to 6%. And just like in Tata Motors, if we believe that the numbers are starting to move, markets pick up, then we'll also take it up. So this is more a plan so that people can also know what are we gunning towards as a business.
So that 4 to 7% is now 3 to 6 for 20 to 22.
That's right.
Oh, perfect, sir. Thanks, Dan.
Thank you.
That's it.
Next question is on the line of Shaili Mohile from Business Standard. Please go ahead. Shaili, your line has been unmuted. Please go ahead with your question. Shaili, so there seems to be no response from the line of Shaili.
Okay, if that's the case, then no further questions, then we can wind up the call then. Thanks a lot, all of you. Thanks for your patience in listening to all the answers. All the very best to you. Take care. Thanks. Bye.
Thank you very much, Mr. Balaji. Ladies and gentlemen, on behalf of Tata Motors Limited, that concludes today's conference call. Thank you all for joining us, and you may now disconnect your lines.
Celebrating 100 years of smile services, a short